Welcome back. Apple trading lower today, down almost 3.5% on a pair of big decisions against the company. The EU naming Apple, along with Alphabet, Amazon, Microsoft, Meta, and ByteDance, as a gatekeeper under its Digital Market Act, which means it will now be facing far-reaching rules aimed at making competition more fair. Meanwhile, in China, government officials have reportedly now been told they not only can't use iPhones and other foreign-branded devices for work, they can no longer even bring them into the office, according to the Wall Street Journal. How big a deal is this? Let's bring in Toni Sacconaghi, senior analyst at Bernstein, covering tech hardware. Toni, great to have you here today. And why are Apple shares down so much?
Thanks, Kelly. Well, clearly, both of these are potential threats to Apple's business model going forward. Apple does 20% of its business in China. And so, look, this is not Apple being singularly picked on in China. This is all non-Chinese branded phones. But nevertheless, it raises the question of whether, this could start to trigger any kind of pro-Chinese or anti-American sentiment towards the company. And given how significant Apple's presence is there, that's certainly going to give investors pause. I think on the EU side, we've known for a while the Digital Markets Act was passed a while ago. We've known for a while it would be implemented in about April of next year. And the real question there is whether Apple will be required, as the legislation is written, to allow for other app stores so people can download apps outside of Apple, which also could have financial implications, although I think those are more muted than the potential consequences of weaker sales in China.
Yeah, no, that's interesting. And I think it kind of gets to the larger question you've been positing, which is whether Apple today looks like the old IBM. And it's fun to make the comparisons. The similarities, both were Berkshire Hathaway's largest holdings. Both have huge index weights. Both are viewed as a high-quality stock. Holding it can't get you fired. And they even have similar size in financials. Apple today and IBM kind of back between 1997 and 2012. So, and I can't even tell whether this is a compliment or a curse. I mean, we know how the IBM story ended, but for a while, it did okay.
Right. No, absolutely. So the financial similarities of Apple over the last 7 or 8 years from an EPS growth perspective and IBM, 10, 15 years ago are pretty similar in terms of they both delivered 11, 12% EPS growth. What is striking is that Apple's relative multiple and absolute multiple is much higher than IBM's ever was. And so the market clearly has more confidence in, Apple's moat and ongoing business than it did for IBM, 10 years ago. And I think, the concern about IBM was really that its, privileged asset was the mainframe and the account control that provided. And ultimately, the mainframe was declining and being disrupted by cloud and industry standard servers. I think for Apple, they have a really strong, installed base and customer moat. But I think the belief is, well, that's not declining. There's right now, we don't see a risk of disruption to people having the smartphone as their principal consumer interface. So, time will tell how it plays out. Both companies were fantastic growth companies for a long time. They went to a more mature phase where, top line growth slowed and they started repurchasing shares. And that in part triggered Mr. Buffett's interest in both names. But, IBM, I think, was facing much more structural issues than Apple is. But certainly time will tell.
Well, there are two warnings in here. And again, you have a market perform on Apple with a 195 price target. But you're warning people, look, revenue growth matters. EPS growth absent revenue growth is unlikely to be afforded a rich multiple. So number one thing for investors to look for with Apple there. And number two, customer lock-in can prove ephemeral when platforms change. So they're doing their best, I guess, with the new headset that may be the new platform. But it's hard to see around those corners. We did get a little piece of news, and I wonder if you would find it significant. The number of people who downloaded, or whatever you call it, Apple TV to watch Lionel Messi play in his first soccer match. Is their bet on content and kind of getting into the living room that way an important part of answering those two potential future problems about revenue growth and customer lock-in?
Well, good question, Kelly. Look, I think Apple's strategy is to try and make the iPhone and its associated ecosystem as complete and as necessary for consumers, that it's essential. And that's why Apple's doing things like broadening into, television. It's broadening them into payments and, buy now, pay later and credit cards. So this device is essential to people. The data point specifically about down loans for Apple TV it is pretty small in the context of Apple overall. We think that Apple TV revenues today, are maybe $1 to $2 billion. Apple's $400 billion, and the business is not particularly profitable. But Apple has a lot of these services, and they continue to introduce and build them. And part of it is to grow revenue and avoid that revenue slowdown, as you referenced. But I think the other is to strengthen the linkages and make that device all that important to consumers, so that ultimately a platform change is less likely going forward.
Right. And especially if regulators are going to come in and try to undermine things like iMessage that were previously a big part of their lock-ins. Toni, as always, thanks for your time today. We appreciate it.